returns come from having access to a lot of different things and understanding that market. I think inflation is here to stay. Maybe I'm wrong, but the interesting piece is that I think turning it back, Andrew, is that no matter what the economic environment is, if you're investing in what we invest in with is growth companies, these are companies growing at 50, 100% a year or more. Whether inflation's 5% or 10%, these companies, you're going to want to be in those companies. If you're in a traditional line of business that's growing at 3% and inflation's 10%,
Yes.
you're dead.
Hello, and welcome to Fireside with VC. My name is Andrew Romans, and today we have Steve Brotman from Alpha Partners on the pod. Steve also, we're going to hear about Silicon Alley Venture Partners, which he had started earlier. And he's been advising one of the oldest, wealthiest, most successful families in the United States, the Pritzker family, whom I guess is partnered in with Alpha too. So Steve, thank you so much for making time to be on the podcast. And if you want to meet Steven in person, he will be on our VC Insight panel. That's right, in person in Pillsbury's beautiful offices in New York City on March 7th. So I'll actually put a link to the show notes. We've got a all-star panel there. In our events, the way we do them, the people in the audience are equally distinguished as those on the panel. So it'll be a fun, intimate night of networking with some drinks and some pithy, good content from Steven. So Steven, thanks for making time to be on the podcast.
You bet, Andrew. Thanks for having me.
Yeah, cool. So I'm really excited about your model because we at 7BC are a perfect candidate probably to be working with you, where I understand that you're, the small fund doesn't always succeed at raising a growth fund to do the follow-on investing. And we've got these pro-ratas, we've got legal insider trader information basically in these relationships. And we can monetize that a bit by sharing deal flow with guys like you, have friends in the Pritzker family and other LPs perhaps. So I can't wait to get into that. But before we dive into this episode, we're going to hear from my buddy, Mark Titirjani, talking about venture debt, and then we're going to get right back to this.
Hi, everybody. This is Mark Titirjani. I'm with Pacific Western Bank, and we are a bank focused on helping startups grow and get to the next stage. We've been working with Andrew and 7BC for years now. Andrew and I go back a decade and a half at this point, and I've always respected the fact that he's a thought leader in the space and somebody that you can learn an awful lot. And he kind of opens up that window a little bit into VC and what's happening in the back room. So we're excited to be partnering with Andrew on his podcast here at Pacific Western Bank. We focus on helping startups get to the next level. We offer a startup services program for companies that are the pre-A, which includes some free banking and some high yield interest rates. And then when companies raise an A round, then we start moving into treasury management services and then venture debt. And we believe that we're one of the leaders in the venture debt market because we are flexible and we can do custom packages and we don't just do off the shelf type of term sheets. So enjoy the podcast. It's going to be a lot of fun. You're going to learn some things and we'll see you on the other side.
Thanks, Mark. And anybody who needs an introduction, happy to share your information with them. Just get in touch with me and I'll put you in touch with Mark. Thanks so much for supporting and sponsoring the pod. So Steve, why don't we dive into Alpha first and then we're going to go back into Silicon Alley and stuff like that. By the way, I was looking at your website and I saw Ari Fogel is like the first photo up there. He's an old friend of mine, great guy. He probably does. They should pay him for the amount of work he does for New York Angels. I'm not sure if they do, but that guy is like really taking it over and been running it for years. Good old friend of mine. I like to give a talk there once or twice a year when I'm in town, and we have a bunch of New York Angels or LPs in our fund. But maybe, we'll get deeper into your background, but I'm just impatient to hear about Alpha. So why don't we start there?
Sounds great. Well, the odds are pretty high that we know probably a couple hundred people in common. And part of that is, given the nature of the Alpha model, is I started out my career as as an entrepreneur, and then became an early stage VC. And one of the things I noticed is that we couldn't do most of our pro rata. And as I approached middle of my career after my second early stage fund, which was pretty successful as well, I had a couple home runs and invested in Facebook and Twitter
Oh, wow.
and Palantir and Bloom Energy, just
Oh my
privately,
gosh.
private in the private market. And as a VC, it's actually relatively easy to, if you're an early stage VC, investing in late stage VC is actually a lot easier in a lot of ways. It's a lot less stress. You don't have to serve on boards. It's interesting model, and your returns come much faster.
Mm-hmm.
What occurred to me, and I made more money doing that than I did my entire entrepreneur and venture career, even though I had a successful career. And I was like, geez, what if I helped my peers, early stage VCs, typically under 100 million in particular? If you have 500 million, a $10 million pro rata isn't that big of a deal. But for a $50 million fund or $25 million fund or even a $100 million fund, that's a lot of money. And to be able to participate in your one best deal, if you invest in 40 companies over your career, there's like 2 or 3 that you really should put everything you got behind it. And so what I started to do some research, and about 95% of the time VCs don't do their pro rata. And by the way, 80% of the technology companies have a VC with less than 100 million in their cap table, oftentimes on
Oh
the board.
yeah, I mean, especially now. Like we've had something like 10 of our LPs have gone off and started funds after kind of hanging with us for a while.
Yeah,
It's unreal. They're spreading like a disease, these new VCs.
yeah, they are. And which is great for us because we get to win with you. We get to win with other VCs, and also, just being able to back your favorite entrepreneurs that you've been with, 5, 6, 7, sometimes 10 years. Just being able to put in some more money at that round. It's uh, just psychically a great reward, and a lot of times these VCs, to justify their continued involvement, both on the company side, but also as the VC. This really kind of, some of our VCs have said, set aside the economics. We just love the fact that we can continue to support
Yeah.
our best companies. And so it's been a fun run over the last 10 years. And we get,
You've been doing alpha with this model for 10 years?
yeah, March will be our 10th year.
Okay.
And we formally started in 2014. But 2013 is when we started, really pulling things together. And we talked to, I had this issue with my own portfolio. We were an investor in Metadata, which dates me a little bit, but they were a software company that helped pharmaceutical companies reduce their clinical cycle times by a year. You can
Okay.
save a year
I've
from,
heard every day a pill is not going into someone's mouth is considered a $1 million loss.
oh, it's
So,
two, yeah,
if you can, if that's a 365-day software license worth paying for.
for a couple $100,000. So you get the math right away. But we were the first investors, among the first investors, and we bought 20% of this company for $1 million. Seed round type of deal a few years back. And Insight came into the B round, and the company was doing much better, doing about 10 million in revenue, 50 million in bookings. And for $10 million, they bought like a third of the business. But we owned 20% of the company at that time, and we couldn't do our $2 million pro rata,
Yeah.
which ended up being pretty substantial return even then. And Insight now manages 20 billion plus. I don't hold anything against Insight for being a growth stage investor, but the one superpower that VCs have, I mean, they have lots of superpowers, but one in particular that every VC has is the power to invest in their best winners. And it's sort of like playing blackjack, and not, if you're familiar with this with blackjack, but if you don't double down at the right time and you don't split your cards at the right time, you're going to lose to the house. So this is the edge. This is the edge that makes it much more lucrative to be a small VC if you can put 10, 20, $30 million behind your best companies. And, we've seen that, over the last 10 years, and our LPs get the benefit of being in your best companies, and we split our carry with our partner VCs. So that's our
So
model.
that's the deal. So it's, and by the way, I'm the perfect candidate to work with you. And I just last week spoke with another fund that was a spin out from Correlation Ventures.
Hmm?
If you know Trevor and those guys, where they're trying to be Moneyball algorithmic there, which I struggle to believe because Trevor's been around for so long that it's like Luke Skywalker's going to use the Force a little bit when he's taking down the Death Star. I just can't believe that those guys that have been in the industry as long as me are going to be 100% algorithmic and there's no spider senses kicking in. But there's got to be some truth of like their model was that if they see a major VC like a benchmark double down themselves, they think the potential for hitting $1 billion outcome, just completely blows up. And they're saying to VC funds that can't raise a growth fund or pull together the SPV, or it is their strategy to use that early stage treasure to go in for a lower multiple in a later round. There's a lot of reasons why someone's not, funding their winner in there, that I think they were saying they'll give you 20% of the profit. So it sounds like, and they were an Inc. So they're an evergreen fund. So it's not a 2 and 20 model for them. So they just want to snowball that. But I think that's pretty fair. I mean, 50-50. And I mean, at the end of the day, for the fund like me, it's 50% of something or 100% of nothing.
Correct. It's hard to argue with that. It's hard.
Yeah.
Hey, I'm only making 100%. Can't, there's only so much you can do. And I think, the upshot of this is that, monetizing those bigger funds. We've had some of our early stage VCs go on to raise growth funds off the basis of their ability to participate in SPVs. So they can expand their platform by not just being an early stage fund, but also growth stage fund.
Okay.
Also, I think you've seen a lot of firms open up opportunity funds. And part of that is been our education to say, look, you're leaving tons of money on the table here. Now, it's harder to actually do that, to actually set up an opportunity fund for a small VC. If you're a $50 million fund, you can barely raise your $50 million fund, let alone an opportunity fund.
Yeah.
We think that we've had a pretty good run, and we've had a great partnership. Today we partner with about 800 VCs.
800. Okay.
And those 800 VCs are almost 80% of all portfolio companies out there. And they don't do pro ratas about 95% of the time. A lot of VCs think they do all their pro rata, but if you go into, I don't know, any TechCrunch or PitchBook, and you just look and see where they were in the rounds, in the seed and A round, even the big funds, even like a Sequoia, oftentimes isn't in their later rounds. So this is a $100 billion market opportunity that kind of just evaporates every year. And I've been excited to innovate here, but also in partnership with some of the smartest people in venture that I know, in their best companies that they know like the back of their hands. So it's been a fun run, as I said, and we've had a lot of success. We now deploy about $5 to $15 million per company, and we move within about 2 weeks' time. Typically within, I can often in 2 or 3 minutes hear a story and let no, this is potential fit. What we are trying to do, just to be 100% clear and open, transparent, is we are looking for those top 1% outcomes. So we're not the shop to go to when your company's bleeding out and you need a new lead investor. We only invest we only invest when you have that new lead investor, and it does feel like we're investing. Um, I think we do look at fundamentals. We do focus on some elements like category leadership. We look for pretty substantial growth rates. Um, we do look for companies that tend to perform in recessionary environments. We do look for companies that with big market outcomes, and so we can pretty quickly assess a company relatively quickly. If it's something that we think is interesting, we'll get back to you in a week and say, hey, we're going to do some more work, and then another week later, we'll have done our work and get to a number and maybe be able to close, within the next week or two after that. So it
So
is a
what's
big process, but in this environment, it's been, it's been fine.
and what are some of the key elements of your decision-making equation algorithm? Like, for example,
Yeah.
geographically, are you USA only? Are you global?
Well, we're not an RIA, so we're 80% US. We can be 20% global. I think it's important to note typically that the technology it's a global industry today.
Mhm.
And if you're a US firm and you go to South Korea to invest in, the next Amazon, which Ben Sun did when he was at Launchtime Ventures, he now runs Primary Ventures. He's got all these opportunities in the US. If he's going overseas, that's going to take that's a substantial amount of validation and motivation. But for us, the bar is a little higher internationally. We're going to want to see a company closer to 100 million in revenue, given the liquidity and issues overseas and currency issues, and it's got to be a real. So, for instance, we were in Kupang, which is the Amazon of South Korea. We were in Kareem, which is the Uber
Yep.
of the Middle East. So, when you land in Abu Dhabi and you ask anyone who Kareem was or Kupang in Seoul, people knew who those companies were when we invested. So
Oh
to the
yeah.
extent we do international, it's more later stage stuff. Also, lately, a lot of the global valuations have caught up to the U.S. And so the arbitrage that we had in 2013 to 2015 aren't there. That's still the case to a large degree.
Yeah.
We saw a company from Africa that basically is valued at the same as this if it was based in the U.S.
Yeah, I actually was on a call with somebody yesterday in Dubai telling me he's mainly focused on Saudi, and he said that the Saudi market and the whole GCC region is massively overvalued. It's kind of like relatively overnight, a lot of money poured into early stage. Everybody's doing copycats. You know, don't think you're going to get a venture studio going over there. And the valuations are higher. Like I remember Early Bird from Germany was saying for decades that the valuations for the same company, if it were in the Valley, we're getting it for a third to half. And then we have the bridge of how to get to the American buyers. All the big balance sheet buyers are in the United States. And it's really not true, especially if it's like an entrepreneur team that's already been venture backed and on their second one. All these people with that government money that are fenced in that can only invest in Germany or only invest in France or the UK. It's like a supply demand thing. And I swear the valuations are higher for the same company there compared to the Valley. And the other thing is sometimes Valley guys or say New York, the more sophisticated ecosystems, they're not just optimizing for dilution. They're optimizing for the next round will be up. Like we're not going to risk a down round by we managed to get everybody to invest it. So you'll see like the same company raises 10 on 50 in a sophisticated market that could have raised 50 on 200. Those investors want a 4x minimum of the post. What's the list of buyers? Sit down with a banker of who to show that to sell to. If you raise 10 on 40 or 10 on 50, you're looking at like a 200 kind of price point to sell at. And there's a lot of people to compete to buy that, But so in the US then, when you're like, what looks like an alpha deal, what's the range of revenue that the company would have by the time it gets within your your sights?
Yeah, I think it's typically a B round stage company or later. B to D would be our sweet spot in general, though those are soft terms because, so from a revenue perspective, we're looking at minimum of 10, probably closer to 20 million. And
Okay.
oftentimes sort of 20 to 100 million is kind of the range. So the closer it gets to 100 million, um, the more mature obviously the business is. But if we invest at 30 million, we want to have a lot of confidence it's going to get to 100 million. Our duration appetite is sort of, I'd say 3 to 5 years, 2 to 6 years duration. It's not
Did
10.
that shift now that, from like the Putin invasion shift in the economy, did
Yeah, I
you shift that out a little bit or?
pushed from 3 to 5 to 6, just because, I think, the reality is that, and that's on average, that's sort of like, you're going to have some outliers off of that. But, where we really want to be is we have a decent amount of confidence that this is a 2 to 4x, 5x
Yeah.
type of return with a 10x potential. And what that means is that we can provide capital to our VC partners, and LPs have a huge amount of demand for these sort of de-risked later stage types of opportunities that are that continue to be able to generate outsized returns. So just because you're getting, if you can basically get uh, if you can get say 10 to 20% impairment rate like a private equity fund might, but with venture types of returns, that's very attractive. So we're educating a whole class of LPs on funneling more and more capital to this part of the ecosystem. And a lot of early stage funds, especially sub 100 million, they just don't have the time, the bandwidth to get into like a growth stage deal, whether this is as attractive. That's not what they do. That's not what they do day to day. We put together our whole analysis and everything else. So oftentimes an early stage fund will come to us and say, listen, we have this C round. And what they would do is they might chuck it back to all their LPs and send them a note. Hey, this looks interesting. They're closing around in a week and a half. Here's the deck. We'll put an SPV together if you want us to. Well, that doesn't really give, LPs are just not built that way, right? They want to know, are you putting in money? Or do you believe in this opportunity? You paid 10 million, now it's 400 million. Like, there's a little bit of a conflict of interest here. And so we actually put together, our own memo. We actually get access to the data room. We often will talk to all the VCs in the cap table, and we'll have a whole melange of data sources that we're pulling on, and we're putting up our own capital. So when a VC comes to us and says, hey, we have an opportunity, we're happy to share our memo, our assessment, our diligence and everything else with that VC's LPs, and they can just sort of check that box off and say, listen, I gave my LPs that opportunity. If they wanted to participate, they can come in. We don't really charge for that. That's not what we do. It's just being a good friend. Also, we'll opine and say, no, you really shouldn't go to your LPs with this company.
So that's interesting. So like, you've got early stage fund like me is saying, hey, let's back these guys at this big valuation, lower multiple, and then we're going to do an SPV, but we'll tap out on what we can do. And then you could help fill in more. And you're saying, we just did an assessment, Andrew, and like, these are reasons why I wouldn't even burn your LPs with this. Is that what you're saying?
That's exactly right. So you don't want to, we're a great source to just bounce stuff off of, to sort of say, what do you think? And the other thing is, if we participate and the company goes south, you can kind of say, listen, we brought in Alpha. They're the experts. They look at hundreds of deals like this. This is what they score this as. This is their memo. They're putting in 5 or 10 million. ULP will have to make your own decision. We're an early stage fund. We're going to stay in our lane. And then if it goes south, that's their issue. They're not going to come back to you. So what happens is a lot of VCs are getting out of the opportunity fund business, because especially when you've got, you know, companies blowing up now. They're like, hey, look, you decided to go in, but we're all human beings. And so, look, I'm in your early stage fund. You put me in this later stage deal. You are responsible. I'm
Yeah,
gonna do that.
there's a lot of psychology, a lot of moving parts, and I've been living it for 20 years. So like we will fund companies in late seed and A, right? It's about 70% is going into A, 30% is going pre-A. Most of that's got 100K MRR, and we believe we can 4x revenue within a year. And then we'll write a bigger check showing a lot of conviction into the A. Because I've been around a long time, we know people from the 90s that if they come to me with a pre-seed pre-product, it's like you don't say no to Jack Dorsey, you know. So if you could, if but it'll be a relatively small check, neutralized by the diversification. But when we get to these, you know, CD rounds, you know, B plus, and we're like, well, one, the multiple's going to be lower, right? You're not going to get a 55x on this. And if you and I had $1 billion fund and we 2x it, that's you and me carving up 200 million a carry every 3 years once you get, you know, into it, and shorter horizons to exits and all that. And you could buy a lift ticket for your kids with a management fee, I think, right? If you got $1 billion fund. So they're going for lower multiples. And so there's a little bit of, I don't want to put fund treasure, which is seeking to make a 10, 12x for a small fund, into one that's going to land between 1.5 and 3 when they're shooting for 4, loving a 2x within 12 months, writing $50 million checks.
Part of the issue that's embedded in all this also, Andrew, is that you have selection bias.
Okay.
Looking at just the growth opportunities in your portfolio, right?
Oh, I see. Like we want to go for our winners, where Alpha is saying,
How do you
I've got
know,
access to all of you.
right? So like, how do you know that's going to be a winner just because they're raising a round? You don't have, look, I'm not trying to be critical, but you just got to recognize that, look, you're in the pro leagues when you, like, you're now in the growth side. So like, I'm looking at 100 VCs that have 2 or 3 deals just like yours.
Right.
Right. You don't have the selection capability. Like, returns come from having access to a lot of different things and understanding that market. So, you know, listen, I'm not saying that smaller VCs can't do it. It's just that by definition, LPs kind of understand that when an early stage VC, especially sub 100 million, they're driving out of their lane. They're already showing they don't have the institutional. They're already you know, shifting their mandate, and they're getting in over their skis. And
yeah, I mean, I heard First Mark in New York with you. They were, I don't know what their LPA said, but they're not supposed to do more than like 15% into one company out of this existing fund. And they're in Pinterest. They want to ride that winner. And I heard they did 25% of the fund and then said, like, we've really gone past what we ever said we were going to do. You can thank me later for, you know, busting out of the LPA, the limited partner agreement. But Ron Conway, I remember he came in with 100 million SPV to lead a $200 million round. And First Mark spun up an SPV to do it. So in that dynamic, they are pushing Pinterest as a growth investment on their LPs. And then you at Alpha step in and say, well, I'm not necessarily going to drag my LPs into Pinterest just because it's there.
right.
Like, it's like Whataburger, just because it's there. I'm gonna literally look at 50 of these things and put my money into the top 5. So it's just purely a numbers game.
I mean, I know, we know the guys at First Mark, of course, and actually have a huge amount of respect.
Me too. Yeah.
You know, so like we talked about the Pinterest round. I think that was around also where Andreessen did something similar.
Was that the 200 million round, the Ron Conway one, or?
I don't know. This was at like I want to say a $10 billion valuation.
Mm-hmm.
So around that was at, and we, you know, we're, you know, I think VCs tread in dangerous water when they start doing that, especially if they're not if it's just sort of they're brokering a deal, in effect, they don't really have any. They didn't look at every social media company in that segment. They didn't look at, they didn't. They're not allocating their own capital. Oftentimes, sometimes they are.
Well, you could argue, you could take another view of it too, that the growth investor doesn't even live here, doesn't know these people. My kids have been in their cars of the founder, like, we've given them advice on, divorce lawyers and everything. Like, we literally know where the bodies are buried, and we've seen their competition. And when are we losing a customer to them? Now that's a real competitor. Are we not? It's just a stupid conference. I'm on the same panel. So I think that the early stage guy thinks he knows something. And it's a bit like if you're buying a used car and you say, Andrew, has the car been in an accident? I get to decide if I want to be truthful or not about what happened, what the true history of that car is. So the seed guy thinks he knows something, and perhaps does. Definitely is going to be pushing their Pinterest if that's the top thing for their LPs. But look, you typically do not want your fund money going into it because you've hit a limit, like the first mark example with Pinterest, or you're saying it's going to drag down the multiples of my high performance fund, but I don't want to miss the opportunity. And so I think what happens is you do the memo to your LPs. By the way, I've done over 75. I think I've got 77 SPVs that I pay for. Like, they're not on some other platform, meaning with our, accounting compliance and all that. So I've done more SPVs than I would have liked to. Had I been more successful in life, these all but would have been fund investments, not SPVs. But what'll happen inevitably is that you have a pro rata of how much we can go in there, and you have these horrible sharp elbow Sequoia people that say, I don't even let you do your pro rata, but you don't get as much money from the LPs in an SPV as the CEO would have given you an allocation for. So that leaves room for alpha right there. And it might be preferable to not do the SPVs at all and work with alpha from my perspective, and even get your insight and everything. And now we're joining forces of all of our insider trader information, and that you're harvesting, and then all of your in your lane stuff, with that. So
it's not it's just like every opportunity isn't an opportunity for alpha per se. Just, it's about helping folks that have these essentially these expiring options lying around. They're not exactly sure how to do it. Hey, look, if you have Pinterest, that's remarkable in your portfolio. You decide if you really want to go for it, but just understand that you are, you're breaking your model a little bit by doing something that you don't normally do. And hey, if you make a big win, no one's going to care. If you blow it up, though, that's on you. And if you plan to be in this business for a long time, and we have, it's, hey, you make those calls. And hey, when we went overseas, when we went to Seoul, we knew that if we blow up that company goes sideways and we make a mistake, what are LPs going to say? They're going to be like, what were you thinking going to South Korea?
Well, that's another dynamic. I'm sure you've encountered this, but like, we've had LPs put bigger checks into the SPVs than they had in the fund, which, by the way, really sucks for us because we get, some management fee to run a business where there's basically zero management fee on an SPV. And I'm like, I can't believe that guy just did 10 million into that. Would have been like 2 million of cash for growing out a team. But here's the big issue is that the LP is not as good at creating a portfolio construction as a typical, seasoned VC is, and they get overexposed through the SPV. So I almost would, even if I've got high conviction on this growth investment, and maybe you're taking some, and you've said, Andrew, we're doing it, so that's even more affirmation for us. And then one of my Japanese LPs puts in a bigger check into this one deal than he's gotten the entire fund, that statistically we're going to get burned. And now that LP is no longer for life, re-upping in every fund of mine, I would have been way smarter letting you drag the Pritzkers into this thing, and you're risk adjusted, than me doing my Osaka guy.
Yeah, listen, as I said, everyone, everyone has a different set of hands that they're dealt,
Yeah.
and you do need to think that through. And I think this is a new environment. We have gone through a phase shift, and what we've noticed is that probably, even bigger firms that had opportunity funds, they're pulling their horns back, and they're saying, listen, you know what, we did that for a while and we're no longer doing that. We're out of that business.
Yeah.
And so, and I think also LPs, hey, when I went to, we spoke, what's ironic was 10 years ago when we talked to LPs, they're like, co-investments, no, those are evil. David Swanson is famous for basically investing in private equity, but also just saying, look, you want to invest in managers who are driving value at the board level. And those managers outperform versus the co-investors, right? And so 10 years ago, most LPs would have that attitude. That flipped quickly when even institutions like Duke, Chicago, other endowments, foundations, even pension funds got into the direct and co-investment game.
Oh
And
yeah.
it's been a total phase change. We'll see what happens, but these things kind of ebb and flow. And I think right now we're on the ebb side, whereas LPs, I don't know what your experience is, Andrew, over the last 6 months, but we're definitely noticing a pullback from LPs to doing their own SPVs. So right now, we think this will be a great run for alpha over the next 2-3 years, where capital is shorter, it's harder to find, and the opportunity set is going to be great. So,
Well, how does it, can I just ask, for my curiosity, how does it actually work? So let's say I've got the growth stage deal that is your 1%, it's a go. Who do you wire money directly onto the cap table, and we just have an agreement that we will split the profit of that investment?
So it's
Or you have a 20 carry, I suppose, and then half of that carry goes to us. And it sounds like I'd be lucky to be the one who gets paid on it when you have access to 80% of all the deals out there with so many other managers. So I show you the deal and you're like, sorry, I already promised it to her.
Well, so just to take that, if someone shares a deal with us, we're pretty, it doesn't happen that often that multiple VCs do it, and it has happened on one occasion. If we actually end up doing the deal, we'll talk to both VCs and say, listen, this is what happened. We'd split.
Well, if it's a pro rata, like, she might have a pro rata and that's all she got. I had a pro rata, that's all I got. And you worked with both of us on the same deal.
And we're pretty transparent. We're not, but what we won't do is if you share the deal and you're ready to go and give us the pro rata and we have your data room and we're all geared up with you, we're not going to go to a third VC and cut you out.
Of course. Yeah. Right.
Quickly with that spread, like people would be like, those guys at Alpha, this is what happened.
Reputation takes a long time to build, but
it's only there's not that many people in our industry. There's hundreds, maybe that quickly, we're all interconnected. So we don't do that. We're going to want to, we'd rather not do the deal if someone really has an issue.
Yeah.
We're not about to do that, but it's actually pretty straightforward. You mentioned doing your own SPVs. We actually just spin up a separate SPV. It can be whatever. It turns out pro rata rights in the forms go to any affiliated fund that you have. So
okay, so that's what I was asking. Like, so you are not investing out of a fund that's commingling them all together.
We have a discretionary fund. What we'll do is we'll spin up SBC Alpha Associates LLC that we'll jointly control, and technically is a fund that you own with us, right?
Okay.
And so you sign as 7BC Alpha, your name, and we create a bank account with institutional
an EIN and all that. Yeah.
Yeah, and we wire the money from that vehicle in, and the money comes in to that account. Everything's audited, right? And there's a carry associated with that. And so it's actually pretty seamless. About 50% of the time, the entrepreneur knows we exist. about 50% of the time they really don't. They don't really care. No one
Yeah,
asks you,
yeah.
Andrew, who are your LPs that are in your fund that are coming in?
Yeah, I mean, look, the truth is we have a lot of LPs, and doing an SPV, sometimes I'm a little concerned about confidential information running around. If we're doing it with a discrete alpha, has got a fully loaded weapon to do this. I'm sure my CEOs would love it. Yeah, they
As
just want to
long
know.
as long as you're straightforward, as long
Yeah,
as
yeah,
you're
yeah, yeah. Let's
and
talk a little bit about the market shift in valuations. What if a company had, like, in general, if you were doing like a 30 million ARR today, not forward looking, not last 12 months, they've steadily been growing, and this is a real reoccurring revenue, software license stuff, 30 million business SaaS deal. Do you think of a multiple of that revenue to get to the pre-money valuation pre-crash of the market? So, and pre-crash was a frothy market. Like, what did you see as a multiple of revenue for pre-money on legit deals in the summer and spring of 2021? And where are we at now? And let's just go with 30. Sounds like it's in your wheelhouse, like 30 or $50 million deal. I mean, revenue.
I think there's lots of folks that, there's lots of data out there, but, in 2021, the range would be 30 to 100 times revenue.
30
And
to 100.
100 times. Yeah.
Yeah, that's just, we didn't do any of that. That's just so crazy.
Yeah.
I mean, because we were saying, look, it may be that the public, the multiple on Zoom or a publicly traded company is 40x now, but most of my life it's been 12x, and 10x. I don't know who came up with that, but 10x sounds fair. And if you've got the G, I mean, and a discounted cash flow, top line, bottom line G, and the WACC discount rate, interest rates are going up, which means we should be discounting future cash flows more, not less. And
We're
but
talking about 2021. That's
oh, I know,
before.
it's nuts.
So, like, yeah, today, it's for a company that's doubling in revenue still, and these last 2 quarters have been pretty horrendous.
Yeah.
Growing 30 to 50% is going to be heroic, but 100% is going to be the new 300% growth.
That's right. Yeah.
You're looking at, for high quality stuff, it's still 8 to 10 times, sometimes as much as 15 to 20. For very high quality, we haven't seen like capitulation. So it's back to historical, but companies that are raising, just thinking like the last couple companies, there's still pretty frothy valuations out there. And I think we're sort of waiting for the other shoe to drop in a lot of ways, in terms of and not only are we talking about macro issues, but as you've been around a long time, there's going to be a huge shift in terms of staffing, in terms of, instead of growth at any price, it's now, how do we grow profitably?
Yeah.
Wait, or even like your pricing. We've had a couple companies be like, we really should be charging 2.5 times what we've been charging in the past.
Yeah.
We were focused on growing quickly, but what are we doing giving away our product at that price?
I think when you and I were entrepreneurs a long time ago, we sold our software for what it was worth. And then there was this sort of Y Combinator 18-year-old high school dropout, a population of entrepreneurs that were bragging about, I've been coding since I was in the womb. And I was looking at these price points, and I'm like, this is enterprise. Like, you're not going to fly any sales guy business class if this is happening. Like, you could hardly send a man in a van and recover that cost for making a sale at that low price point. So I think it's, I think
rejiggering and actually having to sell. They actually have to sell the product instead of giving it away. I had an entrepreneur professor who said, hey, any jackass can sell a $2 banana for $1 and go out on the street,
right,
and sell. you can sell thousands of bananas that way. So now, so what's really interesting, especially at the growth phase, is are you selling a $2 banana for $1? Or, you know, what are you really selling? Should you be selling it for $4? What's your cost of sale? Are you spending $10 to sell that banana? There's a lot, there's a lot that's going to go on. Whole marketing budgets. I mean, Salesforce is just caught up in this recently in their Q3 numbers. Yeah, they're spending $3 billion a quarter, and they brought in $300 million of ARR. Well, it's going to take them 10 years to make that back. Do they really, like, they probably shouldn't spend $3 billion a quarter anymore if they're going to bring in
Yeah, and
300 million.
if you're discounting year 10 by a sensible WACC interest rate, it's more than that many years.
So now we've got like a compression. It's like it's all of a sudden, boom, everything that you've been doing before is, well, out of whack, and you need to retool and figure out what your model is. So it'll be a really interesting next couple quarters. It'll be really, I think the true winners are going to keep on piling in, but even the high flying companies, they're going to have, like Salesforce. I mean, you don't get any bluer chip really than that. They're going to, if they're going through gyrations, you know, earlier stage companies, growth stage companies are going to be going through it, and it'll be an interesting environment. We're looking forward to doing, you know, over the next, you know, being more aggressive like this year and next year and the following year than we ever have. And we've had more capital, we've had more success, and actually, you know, I think it's a pretty interesting time to be investing. But you know, I really appreciate your bringing me on your pod, and you know, this has been a lot more fun than I thought it was going to be. So
okay, well, I'm glad to hear that. Closing question for you. Do you think, I mean, nobody knows what's going to happen with the macro economy, but do you think interest rates are going to go up? Do you think housing prices will be going down? Or do you think that, are we going into more doom and gloom without like an invasion of Taiwan? If we just have what we have now with no more crazy breaking news, what's your assessment on timing for things to look more thumbs up than thumbs down?
you know, I studied economics in undergrad, and I like to think of myself as, I mean, unfortunately, VCs have been forced to become macro strategists,
Yeah.
and then war specialists, and then pandemic specialists. And I've tried to get out of that, but I do think, look, these things run in cycles. We're due for a recession. I'm not saying anything that anyone hasn't, but it's totally feasible that we skirt this. I think though that, you know, I don't think we're thinking about third order impacts that are happening. I think we're going to have another wave of inflation. China is reopening, and it's been really cracked down over the last couple of years. And what I don't think people realize is that, you know, what was the first thing, if you're Chinese and you've been locked down, what are you going to go do?
Travel?
You're going to buy a car and go for a ride.
Yeah.
You're going to burn gas, which means you're going to have massive demand for fossil fuels, which really, we talk about like the super core inflation rate and take out energy, take out food. You know, I think that ultimately, if people are realizing how important energy is into our whole environment, I just believe that we have a little bit of a lull before a higher inflation rate. I think interest rates are going to continue to tick up. I think at some point, what's interesting is that typically, I was reading about this recently, is that higher inflation, higher interest rates typically cools down what sector? Construction. That's like the ad. Well, we just passed this $1 trillion construction bill. So, you know, it's not one for one, but a lot of those folks that were piling nails into houses are going to be doing something else in that. And so it's unclear what happens in that economic system. I think you're looking at continued inflation, more wage pressure. The other thing is demographics. Demographics, we are the next, this, like, part of the reason why we don't have the layoffs that we have and why these companies have hoarded employees is that they don't have the people to replace them. The next generation is smaller than the prior generation, right? So we could have a weird situation where demand for labor is skyrocketing and their labor costs are going up. So we could basically have essentially a shrinking economy with full employment. It's a really weird dynamic where you have full employment in a shrinking economy. That's what you're going to, China just reported this is the first year that they had shrinking population.
Yeah, so yeah.
Most people think that they've been shrinking for 12 to 14 years.
Yeah, well, they got rid of the one child policy. That was a bit of a signal.
But you know that they've burned their numbers are all cooked for the last 12 years. They've been losing population for a long time. Japan just sounded the alarm. Germany, USA, you know, I think the US is in decent shape, but we have some work to do. So like I think inflation is here to stay. Maybe I'm wrong, but you know, the interesting piece is that I think turning it back, Andrew, is that no matter what the economic environment is, if you're investing in what we invest in with is growth companies, you know, these are companies growing at 50, 100% a year or more. Whether inflation's 5% or 10%, these companies, you're going to want to be in those companies. If you're in a traditional line of business that's growing at 3% and inflation's 10%,
Yes,
you're dead. So
yeah.
what's really interesting is that we're really in the sweet spot of this type of, in the 70s, you know, actually that started the whole shift to investing in tech, right? Apple computers, Microsoft, you know, Oracle, like these very efficient, capital efficient companies thrive in recessionary environments. Now, the value of those companies falls as inflation goes up, as the interest rates go up. But the core businesses are phenomenal. And if anything, you know, we're looking at all sorts of things that our companies thrive during disruptions, right? So they can't hire enough labor in Germany to sort their mail. Well, robotics and AI are a great solution for that.
Technology's answer to everything.
Right? Well, so like in that's my point is like, so I'm more bullish, and this is now 25% of GDP. As an allocator, you can't not be in tech today. What are you going to be? Are you going to go overseas? Are you going to go in fixed bonds? Are you going to go, you know, you're going to go into, you know, the coal mining? What business are you going to go into? Tech is really, from my perspective, you know, the Tina of this next era. It's almost like you really you got to be here, and this is where you're going to maintain your wealth. And I think it's going to be an interesting segment. And of course, we have a lot of falling trees like the crypto business, but there's going to be new opportunity sets that, you know, what's really interesting, and you've been around for a while, I've been around for a while, but every technology revolution is about 10 times bigger than the prior wave. If you think about minis to mainframes, PCs to minis, mobile to PCs, you know, client server, internet, social, mobile, every time it's 10x bigger. You know, I don't know if AI is that or something else that's around the corner. But it's, you know, you got to be in it to win it, and to maintain wealth. You know, being a technology investor is more important than ever, I think. So I'm super excited about what's to come, and I'm looking forward to being on your panel in New York. Thanks for inviting me. I look forward to being there and contributing.
Yeah, no, that'll be cool. I think that the room is going to be packed with people that should be working with you. So we've got to have a lot of, you know, big and new VCs in the room. So it'll be a lot of fun. Well, Steve, thanks so much. Can't wait to see you March 7th, man. I'll see you in a few weeks.
Yeah. Bye.
Okay. Thanks so much. Bye for now.
Well, that was certainly interesting. It's Mark DiTargiani with Pacific Western Bank back here. Again, really excited to be part of the podcast with 7BC and Andrew. And we're excited just to support the ecosystem and help you get to whatever your next step is in your business journey. Thank you very much.